Coming in, let's get a move on and focus in on earnings. Bajaj Auto reported a 53% year-on-year fall in its net profit to 528 crores for the June quarter versus 1125 crores in the same quarter last year. Net sales as well dropped about 61%, and the management cited the supply disruptions in the quarter to the COVID-19 pandemic, the lockdown, as well as the decline in demand as having impacted the quarterly numbers. My colleague Karunya Rao joins in to sum up the quarter. Karunya, revenues and bottom line pretty much in line with what the street had estimated. Let's in fact hear it out from the management conference call, which is currently underway.
96 crores for the quarter. Having said that, Q1 last year was a relatively weaker quarter in the US. Ex-US also we grew 62% to 175 crores for the quarter. This, I mentioned, was due to the serialization issues in the past. And the API grew by 54% to 264 crores for the quarter. I'll hand over to Shaunak to give a brief on the domestic business.
Yeah, good afternoon, everyone. For Q1, the India business, the numbers have been circulated. We grew at a negative 6%. This was in line with IMS industry numbers as well as so that is in line with industry. I think we saw severe challenges in the month of Q1, especially in April, May, and parts of June due to the strict lockdown throughout the country. In terms of the impact on business, we saw a pickup in June, and if I were to take the first 20 days of July, we are seeing a pickup of the business. Despite all of this, I think at an overall portfolio level, there's been a drag in two specific areas. Those specific areas are the liquid formulations, which largely go into the pediatric usages, whether it's antibiotics and cough and cold, which are large dependent areas for us. We've seen a severe drag and it's reflected. Those same drags are being reflected for the industry in strict liquids in IMS data. Also, partly there's been some drag in the hormone part, the gynecology portfolio. Largely, we feel these are two very specific drags in the portfolio driven more by market dynamics today in this period of COVID. Other than that, I think the expenses in Q1 were managed to ensure that profitability stays in line with budget. So we have taken those steps, and in Q2 we expect, to make sure that top line again starts to grow, and we have mentioned cost cutting and management of middle lines has happened in Q1. I think two other areas in Q1, there have been no special discounts and special trade schemes being given to the market to ensure pipeline billing. We have made sure that despite a lot of pressure from the trade as well as our competition resorting to putting these pressures in, we spent the last 12 months as previously communicated to clean up trade discounts, trade practices, and to ensure that we largely became a prescription-driven focused company, and that should only drive our sales. So we feel that it wasn't right for us after 4 quarters of this to restart it, and we have resisted and we will continue to resist on this. In terms of the overall business impact of the restructuring, the cost correction interventions we took last year, we feel if I look at a mix of Q4 performance and parts of June and July that we're seeing, I feel the part of the correction has happened and is reflecting in our portfolio. Going forward, we feel that the portfolio will outperform the represented market. And going forward, as long as, despite the big drag on our liquids portfolio, which historically is a portfolio that always does well for us, and I think for many quarters going back, I think the portfolio